People talk about the local market slumping. A, is it? B, are you buying regardless or stocking cash for the bottom of the market? That's a really good question. People talking about the local market slumping. So I'm going to take this question and talk about Dayton specifically. And as far as the slumping goes, I'm going to take that as meaning that properties are sitting on the market for longer and that more price decreases are happening because they're sitting on the market for longer and these homes aren't moving. And this is kind of one of those two-pronged answers, right? So first, I'm going to say, yes, it is. There are properties that have stayed on the market for a very long time, and there are a great number of price decreases currently happening. However, I would say that these are not important metrics in the sense that they're generally, applied for. And I would say that, the market here has gone up so fast that now I feel like you have a lot of people that have wanted to sell homes or are interested in selling their house, and they see how low the inventory is. They see the comparable sales for homes in their neighborhoods. And if a home in their neighborhood has sold for 100,000, and historically, they view their property, they purchased it 5-6 years ago for 30 grand, 40 grand. They're going to say, okay, well, if that property sold that's 1,200 square feet for 100 grand, then my property should sell for 100 grand. So right now you have a bunch of trash with deferred maintenance, with sloppy rehabs, with corners cut, listing on the market for 100 grand. Unlike the first property that sold for 100 grand, where somebody rehabbed it to the best of their ability, everything looks fantastic. For the most part, everything is new in it. There's no deferred maintenance on the property. You've got, people that haven't done anything, and they're trying to, at this point, the inventory is just so low where I don't feel like there are enough people in this market that are rolling out high quality flips. You've got some people flipping properties and there is, a half inch of caulk on the back of their granite countertops. And people go through that and they see how sloppy this work is done. Sure, the right materials are there, but the craftsmanship is horrible. There's funky smells in it. There is a cast iron stack in the basement that still has a clear crack in it. So as soon as somebody moves in, that's going to be an issue. They rehabbed the whole bathroom, but for some reason kept the green tub. Why? And these are the properties that are sitting on the market for obvious reasons once you look closely. And these are the properties that are taking price decreases, as they're sitting on the market. While a slump is happening, I would say it's because there aren't enough quality products inside of the inventory. And subsequently, you've got a bunch of trash now listing itself for, top dollar when it can't call for such. So these properties are listed for sale for a month, 2 months to see what happens. They'll decrease the price occasionally. And then once there are no takers, they're going to take it off the market and use it as a rental until, they can collect more deferred maintenance and, list for lower in the future or recover some of the funds that they think they put into the property. However, in saying all of that, I will say that I still see when a property that is priced appropriately, whether it's high or, middle of the road, if it's like this property that I just used in this example, if they actually listed it on the market for $40,000, it would sell. But they're trying to pawn it off as this $100,000 property, and that's just not going to happen. Inventory is low, yes. However, we're not in this market where, people are willing to pay more than they should for what they're getting. So all the properties that are appropriately priced or well rehabbed are going very, very fast. From what I've seen, we're still in an extraordinarily strong market with very low inventory. And, I have been putting in kind of low offers on the MLS. And what has happened very frequently is that, a property will list itself or get listed for 60 grand. And I'll look at it and I'll say, okay, I'll use that formula that I talked about where 75% of the after repair value minus all the repairs. I'll go through it. I'll figure out, what a fair price is, and I'll offer that. And it's a fair price. A lot of times we're told no, which is fine. I hope they can sell it for more than what I think, because that means that the market is still going up. However, a lot of times what we have experienced lately is 3, 4, 5 weeks later, after they get offers, but then, those people let the deal fall through because they walk it, they smell it, they see all the deferred maintenance, they see all the corners cut. Sure, it took great pictures, but when you get up to it, it is not good at all. And then eventually, these people will come back and say, hey, we will accept your offer, or they'll turn it into a rental. But that's my personal assessment of the market. I watched this fascinating video recently from UCLA talking about the current conditions of the economy, and they were mainly talking about where they were out in LA. But one of the points that the guys made was he said that he's starting to see some statistics pop up, and this was in June of this year, so it's a little bit dated, but not too much. He said that he was starting to see some statistics of, hey, people like panicking because the inventory has increased by 20 or 50%. And his whole point was, well, if you look further than like the past 2 years, then inventory would need to triple in order for us to get back to our like old normal. So the inventory is so low that it needs to 3x from where it is now in order for us to get back to the levels that it was, kind of pre-pandemic, or whatever marker you want to use as an indicator. So you should keep that in mind as well when we're talking about inventory. In all my research and all my talking to mentors and all the interviews that I've done with people where they did lose everything, I would say that if you have the means to pivot, if you are staying agile, if you're not afraid to change your strategy as the market conditions change, then you're going to be okay. If you are consuming a lot of this doom and gloom content and you want to not feel like the world is falling, then you can research some companies that started during the Great Depression years. And if you look at all these economic downturns, if you do the right amount of research, then you can find companies that are, large staples in our society or personal consumption at this point were started during the Great Depression years. So there's always going to be a way to make money. There's always going to be something that you could do to turn a profit. You just have to find that. And if you get an indication that your plan is not working, then you should likely change it. And, we do our very best to stay on top of the market, on top of our strategy, figure out where it's working, figure out where we might have faults, and figure out in what ways we need to change. And one of the things that I would say in thinking through this and in seeing the way that the market is changing is, as interest rates, which are for sure going up, continue to go up, then what that's doing is limiting the buying pool. Now, on one hand, since the inventory is so low, it doesn't necessarily matter how many buyers are in the market because the inventory is such that everybody that wants to buy a home doesn't have the ability to do so. However, as financing is more expensive, turning quick cash flow becomes more difficult. And as that becomes more difficult, the purchase prices are going to fall a little bit. And I heard this really cool quote. I don't remember from where, but I really enjoy it. And that is, marry the house and date the mortgage. So as you have the opportunity upcoming to purchase properties for lower than usual, you should do so. And once the interest rates start lowering themselves again, you can refinance. I was watching, some video recently. This whole article, the premise was compared to how low rates were previously on like a $400,000 house. Over the 30 years that you're going to have that mortgage, you're going to pay $360,000 more over the life of that loan on interest alone, which is just unaffordable for so many people. And fundamentally, I just disagree with that perspective because nobody is going to hold a mortgage for 30 years. I think the number of people that keep the same mortgage, especially as, one of the things that is fun about real estate is when you refinance, for the most part, it's a tax-free event. So if you have the ability to buy a house for cheaper now because more people are not interested in holding that monthly mortgage payment or paying that, then hey, buy the house now. Suffer for it for now. Don't look at the 30-year accumulation of how much interest you're paying. Know that you're going to refi 3, 4, 5 years down the road whenever the interest rate's lower to a point where it makes sense. Unless you're one that's predicting that the interest rates are going to stay high forever. But I think that is the more appropriate way to look at it. So Our initial basis on properties may get lower. Yes, for a short period of time, the amount of cash flow that we're able to make might be lesser. However, if you look at it, once we have the opportunity to refinance multiple of these at a time, the cash flow is going to increase. We're going to have a windfall of cash flow once interest rates lower and we're able to refinance on the assets that we were able to purchase for lower during this time when people are talking about the recessions or such. So I would say that that is our plan. We're going to continue to buy. We're going to be acceptant of the fact that the more mortgage rates and the more interest rates increase, that's going to hurt our cash flow. However, so long as the values of the homes don't tank, by like 50%, then the purchase prices, our new purchase prices, are going to give us a higher equity. And in the future, we'll be able to pull out more of that equity on a tax-free basis as we refinance. So yes, you're going to sacrifice some short-term cash flow as interest rates continue to rise. That's a fact. But if you are able to, with these higher interest rates, still acquire properties that cash flow, you should do so. You shouldn't speculate on appreciation. You shouldn't speculate on what the economy may or may not do. You should continue to use that formula. I would say if you can find a property that fits the mold of, you can buy it for 75% of the after repair value minus any of the outstanding repairs, and you can rent it out and the property still cash flows after all of your expenses, even if it is, $50, $100, you should do so. And then when interest rates go from 8% to 5%, that'll increase your cash flow on a monthly basis. Your cash flow will go from $50 to $100 to $200, $300 per month, right? So that's what I would suggest. I would not slow down. I would pivot. I would keep that long-term perspective. We're not going to slow down in buying homes. We're just going to be accepted of the fact that interest rates impact cash flow. To couple that, to add on to this point, I know I've really been rambling on this for a long time, but I would say that right now, as part of the mastermind, we're going through a book about Charlie Munger, and we're watching a lot of interviews that he's done. And one of the things that he said that really resonated with me and made me pretty happy was sometimes the tide is against them and sometimes it is with them. But regardless, he keeps swimming. And I think that is the perfect way to look at the market. Yes, sometimes the market is going to be working against you and your business, but that doesn't change the fact, that doesn't make someone say, I need to get out of business. Maybe pivot a little bit to stay profitable, to increase revenues. But yeah, the market's against you. And then other times the market's for you and everything is pushing you in the right direction. Everything is, your asset values are increasing. Your cash flows, your rents are going up, your cash flows are increasing. And those are great times to do business. Those are times when a lot of people that don't take this too seriously, don't do the research, don't analyze the deals as strictly as they should, also hop in. And then as soon as the tide gets against them, they're going to start falling out. And Warren Buffett has a good quote that says, it's when the tide goes out that you see who's been swimming naked. And I think that's a good quote. And I think all of this goes together. But I would say from a fundamental perspective, if you are buying good properties, if you're buying cash flow assets, you should continue to do so. One of the guys in the mastermind who owns a little over 100 doors here in the area, he has, I think he bought his first house in like 06 or something like that. He invested all the way through the crashes. And he said, hey, for real estate investors, recessions and downturns really mean that you need to double down and you need to buy more assets during that time. And he said, if I got to do 2008 again, I would buy twice as much as I actually did. I think that has some weight to it as well. So if you put all of this together, I would summarize and be overly harsh and probably a little bit exaggerating in my closing statement of the people that have the opportunity to say things likely are not the ones doing it. And the people that are doing it are going to continue to do it. So all the people that are incentivized to make these videos talking about how horrible the economy is and how everything is falling, they're not actually out here doing anything. And if you start listening to people and weighting their words based on the accomplishments they have in the past, I think it really spells out a different story. And you've got, a lot of people on YouTube that have massive followings that have no real life accomplishments, but they're the ones that are trying to coach you through this next recession. So be careful, really be mindful of what you put inside of that very important, very powerful brain of yours. Listen to people like Howard Marks. Read his book, The Most Important Thing. That was written kind of during or right after the 2008, the last crash. Invaluable book. I've read it a couple times now, and I'll probably read it a couple more. Charlie Munger, listen to a lot of interviews, read the books about him. Same with Warren Buffett. Charlie Munger's 98 right now. I think Warren Buffett's 92. They've lived through and seen a lot. So that's what I would say that we should all be doing.
Thanks for watching that clip. I thought that was a good question. And I think you can ask good questions too. Join us every Friday morning at 8 a.m. Eastern Standard Time for a live stream Q&A where we answer plenty of questions just like this one. In the meantime, consider subscribing to the channel if you want more of this content. And if you want to increase your deal flow, analyze properties better, and help me feed my family, click the link below for a free 7-day trial of PropStream.